this is Nathan Boxx, Director of Retirement Plan Services at Pitt Capital Group, and thank you for joining us on All Things Insurance with Megan Chicone from State Farm. First, I want to thank you for those that tried to join us live. I appreciate you taking out the time, and I deeply apologize for the inconvenience that our technology mishap had on your schedule. And to try to make it right with you, we're offering individual sessions for anybody that would like to speak to us about their personal situations or a question that you didn't have a chance to get answered. So you can find our information below with our contact information to reach out to us, and we'll be happy to find some time to meet at your convenience. So thank you. Let's get started. So first, you've probably noticed that Megan and I are not practicing any sort of social distancing protocols, and neither of us are wearing masks. That's because we've been sheltering in place together in our home with our 3-year-old son, and we're broadcasting this from our kitchen table. So
if anybody has any ideas of social distancing within the house, in a townhouse, please let us know, because we've been trying to figure that out.
So to get started, we're going to try to make this fun and interactive as much as it can be, and Megan is going to test my knowledge on some basics of insurance, and I would encourage you, those of you that are watching this, to play along at home. So Megan,
yeah, I couldn't let him have a webinar inviting me and then me not have some type of control over the video. So I of course had to put together a little quiz to test his knowledge, and like Nathan said, play along. These are common questions that we get on a regular basis. So let's just see how much Nathan knows, and of course let's test your knowledge as well. All right, so here we go. Your homeowner's coverage should equal the estimated replacement cost of your home, not the purchase price. So estimated replacement cost is what we estimate it's going to cost to replace your home if something happens, and that should equal, your homeowner's coverage should equal that, not your purchase price. True or false?
That is going to go with true.
Yes, you are right. So there's a difference between market value and purchase price versus what an insurance company considers an estimated replacement cost. All we're concerned about is cost of material and cost of labor to rebuild your house if something happened today. So
it'll be important for folks to reevaluate that as they go on.
Yeah, absolutely, and reevaluate.
You've lived in a house for a long time.
Maybe you've made some additions since you first purchased the home, or a lot of people, buy fixer-uppers, and so what we may insure the house for at the time of purchase could be different 10, 15, 20 years down the road if you do any additions, any exterior construction. Definitely, give your agent a call and let them take a look and just make sure that your policy is updated. All right. Okay. Number 2, your homeowner's insurance policy covers flood damage.
I'm going to go with false, but kind of.
You're right. So you went with your gut. So your homeowner's insurance policy, flood coverage does not extend under any traditional homeowner's policy. And for you to have coverage extended, you would need to purchase a policy through FEMA. Oftentimes, you will know when you buy a house if you're in a flood zone, because if you have a lien holder or you have a mortgage on the house, the bank's going to require you to carry it. But thinking of other things that may not be covered under the homeowner's, earthquake damage. So in Western PA, we have had a couple earthquakes, but nothing that has caused severe damage. So you can endorse the policy, but it's not included under a traditional policy. Earth movement, foundation issues not covered. What are some other big ones? Mine subsidence is pretty big in Western PA. That's something that you can talk to your agent about purchasing either through the company or with State Farm. We purchase it directly through the Department of Environmental Protection. So we can get you coverage. We just have to go through the state. Landslide, that was a big one a couple years ago. Had a lot of calls when there was that landslide up in Mount Washington, and unfortunately there's not coverage for that, and you can't buy it either. So all right, so you're 2 for 2. All right, here we go. A solution for people who want extra levels of liability insurance protection above the limits provided under their auto and homeowners policies is called an overflow policy. So additional liability protection above the auto and home is called an overflow policy.
Sounds like it could be true.
Oh, come on. You should know this. No, it's a personal liability umbrella policy. Is what additional liability. And if you have not talked to somebody about a personal liability umbrella policy and you have assets that you've worked really hard to protect, I highly recommend you get some information on this type of policy. It's inexpensive for the amount of coverage that it provides. Like I said, we work hard for what we have, and for an incident to happen that is unfortunate or would cause bodily injury or property damage to others, to have this extra liability coverage for minimal amount of premium, I think it's one of the wisest things that you can do. So if you don't have information on it, you can certainly reach out, but talk to your agent or just look up personal liability umbrella coverage. Okay.
All right, so I didn't get that one right.
No, you didn't. So I gotta keep tally here. So, all right, your address may impact your auto insurance rate. Your address. So where you live could impact the rate on your insurance.
Well, it's true on that.
Right. And so what are some other things that can affect your insurance?
Well, certainly whether or not if you live in an urban, suburban, or rural area, that's going to have an impact on your rates. Where in the country you live, whether or not you're, like here in Western Pennsylvania, running into deer all the time, or in the Midwest where you have tornadoes that roll through. So certainly where you live is going to impact your insurance rate.
So age, where you live, the type of vehicle you drive, the cost of the vehicle you drive. Vehicles are more expensive today. And a lot of times people think, well, my vehicle has all these safety features and it's going to be less expensive, but those safety features also cost a lot to repair and take our laborers much longer to fix than they did in the past. So that can cause insurance to increase. Credit is a big one that affects. So we don't pull a credit score per se, but individuals or households with good credit do have better ratings. There's actuarial science behind it that say, if you have good credit, you're less likely to get in an accident or less likely to file a claim. So that's another factor. Young drivers, so we talked about age, but young drivers in the household, that of course affects the rate as well. So, okay. All right. So number 5, your life insurance policy should cover 10 times your yearly income.
I'm going false.
Yeah, so it's not a one size fits all when it comes to life insurance. And we'll dig in a little deeper to life insurance. I know there were a lot of questions around life insurance and the types of policies out there, but everyone's situation is different. And I can't tell, Nathan that he needs 10 times the amount of income, and my neighbor and our situations are the same. Our family dynamics are different. So it's really individual. It should be a custom policy that fits your needs. Okay. And we'll go into that a lot more in a little bit. So this is a big one. I get this question a lot. So your neighbor borrows your car and wrecks. Don't worry. His insurance is going to cover the damage. So neighbor's driving your car, he wrecks, his insurance covers it. True or false?
False.
Yeah. So insurance always follows the vehicle. As long as you give permission to somebody to drive, your insurance follows the vehicle. So you drive your parents' car or you drive the neighbor's car, their insurance is going to cover you for any damage, okay? You rent a vehicle on vacation. Now, this is a big one, especially this time of year. We get lots of phone calls around renting cars. So you rent a vehicle on vacation, but no need to purchase insurance through the rental company. Your insurance extends. Correct, yeah. So there's a small gap in coverage. So most often when I think every time we've gone on vacation, we've never paid for the insurance that the rental company provides. We have comprehensive collision coverage that's going to extend coverage to that actual vehicle, and then we have liability, which also extends. So we're good. If you have a liability only vehicle, then you're going to want to purchase at least comprehensive and collision through the rental company. And the other thing that it doesn't cover is, like, let's say we were driving a rental, we got in an accident and they lost revenue on that vehicle for a week. That loss of income is not something that's going to be absorbed by your personal insurance. So that could be something that could be an out-of-pocket expense for you.
So it's important to make sure that you review your auto policies to make sure you
know your deductibles going in. Like I said, we get a lot of calls on this just saying, I know I call every year, but I just want to confirm that my coverage is going to extend. So it's good to double check, always double check with your agent. All right, so there was a bad storm last night and your neighbor's tree fell on your shed. Your homeowners covers the damage. So this has been a common question lately, just with the big wind storms and coming through. So what do you think?
I think that their insurance will cover it. So true.
Okay, so if it falls on your shed and there's no negligence involved, meaning it wasn't a dead tree, it wasn't something that they ignored for years and you've had conversations about, your insurance is going to cover it. So it's technically an act of God, right? They can't help that a strong windstorm came through and blew that tree on your shed. And like I said, as long as they're not negligent and they didn't ignore an issue that should have been taken care of, it's your insurance. So you would be subject to your deductible and your insurance would take care of it. So we get a lot of those questions.
I can knock on his door and ask him for money.
You can always have a conversation with your neighbor. We encourage people to have very civil conversations when it comes to cutting down the trees that hit the house. So, all right, a couple more questions. You hit a pothole. If we all live in Pittsburgh, if you're watching this from the Pittsburgh area, you know we are dodging potholes at a certain time of year. You hit a pothole causing damage under your vehicle. This is covered by comprehensive coverage. No, it's covered by collision.
Collision.
Yeah, so collision coverage, it's the same thing as like if you're driving and you slip on ice. I know that you didn't see the ice or didn't know it was there, but you should be in control of your vehicle at all times. So you should know that that pothole, or should at least be paying attention to be able to see that pothole. I know it's not always, you know, like what we think when we're driving at that minute. But pothole would be subject to your collision deductible, and then the insurance would cover up to the actual cash value. Okay. All right. And the last one is you rear end another car and they need a new bumper. No damage to your vehicle. You owe your deductible for his repairs. So you rear end somebody, damage to them, no damage to you, but you still have to pay a deductible. True or false?
True, I would be responsible for their damage.
Yeah, no, false. So their damage is going to be covered under your liability protection. Now, if there was damage to your vehicle and we needed to get our vehicle fixed, then we would pay the deductible to get our vehicle fixed. But when you cause damage to somebody else, that's covered under your liability, and there's not a deductible that applies. So, and oh, I'm sorry, we had one more question. True or false? Megan is the best State Farm agent.
Ooh, that's an easy one.
Did you get? You better get that one right. Anyways, all right. Well, thanks for playing along. We kind of just wanted to warm it up a little bit. Common questions, basic insurance fundamentals for you to think about, and maybe you've had that question, or maybe you will get that question in the future and you don't know the answer.
Good stuff. Thank you. So obviously there's some gaps in my insurance knowledge I need to work on.
Yeah, good thing you have somebody to ask. Yeah. Okay.
All right. So moving forward, whenever we're talking with clients about their financial plans, insurance and life insurance certainly enters that equation. Now, there's lots of different types of insurances, life insurances, and your needs as an individual and a household are going to evolve as your financial picture. So maybe let's start with the most basic form of life insurance, term life insurance, and maybe tell us how it works and who it's right for.
Okay, so two basic types of life insurance, term and permanent. Okay, so Nathan, you're right. Term insurance is truly the most basic in forms of the easiest to understand, but not all term policies are the same. So it's important to know what you're purchasing or what you're looking at when it comes to term coverage. So the benefits or key features of a term is that it does allow one to purchase a large amount of coverage for minimal premium. And typically it's for a term or a period of time that you need that large coverage. So it could be a 10-year, a 20-year, a 30-year period of time to cover an expense that's going to eventually go away. So think of things like a mortgage. We all hope that we're going to pay off our mortgage in a certain period of time, and it's not going to be something that's going to be with us for the rest of our life. Income replacement, if you have dependents, young children that are dependent on your income or the household income, or certain spouse's income. Eventually, we all hope that that need will go away after a certain period of time. So it's a larger need. So you're able to buy a large amount of coverage for a minimum amount of premium, and you lock in that premium for a certain time period. After that time period is up, though, if you don't pass and a benefit's not paid, you walk away from that policy. There's no cash value. Okay, so that's could be a downside, or maybe that's not important to you. So you walk away from it. It's kind of like renting. So you rent a house, you put the money in to pay for that year for a roof over your head. But when you leave, you don't have any equity in that house. So that's the same thing as term. There's no equity in that policy. Now, I said there's different types of term policies. So there is level term, there's decreasing term, there's a return of premium, which we can talk about. But when you're buying a term policy, you need to make sure, is my premium locked in for that full term, or is it going to increase as I get older? Is my death benefit going to stay the same? So if I think that I'm buying a $250,000 policy, is that policy going to pay out $250,000 18 years from now, or is that policy decreasing? There's policies out there that are set to decrease. They're basically like mortgage protection policies. So as your mortgage decreases, the death benefit decreases as well. And then we have a really neat product. State Farm is one of the only companies that offer it. It's called a return of premium. And it is a term policy. You lock it in for 20 years or 30 years, but 100% of that premium that you pay into that policy, should that policy not pay out, right? So you live through that term, you get 100% of your premiums back. So it's a little more expensive than a traditional term.
So it's going to change your premium a little bit.
So your premium is going to be more than a traditional term where you don't get any money back. But at the end of that 20 or 30 year period, instead of walking away, you get a check for the full amount of premium that you put in. And so there are people out there that don't like the idea of putting money into something and then nothing happens in 20 years, right? Thankfully, but you just put, let's say $10,000 into this policy for this peace of mind that you have coverage, and then you're walking away from it. But then there's also people that don't want to or cannot budget for a permanent whole life policy for the large amount of need that they have. So the return of premium is, it's a nice middle policy that we can offer somebody who's in that situation. So it's a great product. But it's not for everyone. And of course, we would need to have the conversation and just provide options of what's best for that individual and for that family. So, but those are the three different types. The other things that I just want to touch on briefly with the term policies is when you're looking at a policy, like I said, not all policies are the same. And there are features and options and benefits within policies depending on what company you're writing with. So there's things like waiver of premium for disability. That is an endorsement or an option available to you that allows you to waive premiums should you become sick or disabled. So let's say you're sick, you're disabled, you're not able to work, your income is obviously now most likely less than what you're making, but your expenses are up. And now you really need that life insurance because most likely you're ineligible for buying additional. The waiver of premium for disability, we waive that premium. No one pays it and your policy stays in place. So look for something like that. A guaranteed insurability option, that's another endorsement to a term policy and a permanent whole life policy that you can add that guarantees your insurability. So let's say you become sick or disabled. and you're not eligible for insurance.
Sure.
You will have certain periods throughout your life that we would offer you additional coverage at that age, at that cost, but no underwriting questions asked. So we can talk about kids policies, but that's a big reason why we talk to parents about coverage on their kids, is because of this guaranteed insurability option. The two other things of term policies is the convertibility feature. So again, should you become sick or disabled, are you able to convert that policy to a permanent policy without any underwriting questions? Not all policies give you that ability to do that. A lot of work benefits don't give you that ability. And is your policy renewable? Meaning when that term is up, are you able to renew that policy for
keep it going?
Yes, exactly. So those are things like I said, you think, oh, term, I have term, they have term. It might not be the same policy, just like all car policies. Not everyone carries the same amount of coverage. So comparing your premium to somebody else's, well, what do they have? How are they protected? What are they insured for? So it's good to just know what type of questions to ask when you're going in and looking at that term coverage.
Great. So a lot of good options. So it sounds like term is the right solution for folks that just want to insure against, a specific risk that's only going to last for a certain period of time, such as, my untimely death before our mortgage is paid off, or before the loss of income, before our son reaches age of majority and is on his own. Right. So good solution there. So another question that we get from folks is, what if we have a spouse that stays at home? Do they need, should they get life insurance?
That's a great question, and it's a topic that comes up for discussion frequently. And make no mistake, your stay-at-home spouse may not generate income that you see into the checking account, but they prevent a lot of that extra money going out from the things that they do. So think of what you would have to pay if something happened to them for childcare. Daycare, we know, is not inexpensive, and maybe you prefer a nanny that comes to the house. Grocery shoppers, okay, they do that. They cook, chefs, house cleaners. We've learned recently in the last 3 months that, we're relying heavily on that spouse that can educate our children from home. So if you add up all that they do,
to run a household.
I actually think there was a stat, I think it was salary.com gave this statistic. Now this is a nationwide average, but a stay-at-home spouse, they estimate 176,000.
Oh wow!
It would, so they definitely bring, even though, like I said, it's not money that goes into your checking account, they prevent a lot of those extra expenses from going out. And think of it, if you have a stay-at-home spouse and he or she is at home taking care of the children and something happens to them, one, you need time to grieve, okay? Nobody is going to expect anyone to jump back into the workforce, right? You need time to grieve. You need time to plan, figure things out. And how about your children? It might only take you a certain amount of time, but you have children that you now have to help through that grieving process. That may take you away from work. You're certainly going to be distracted. If you're paid on commission or things like that, how do you focus on everything, right? So the life insurance, it just buys you time to think of a plan B or a plan C. Also, I always think of my friends that stay at home and all that they do, and what their spouses would be in charge of if something happened to them. And then I think of our friends that don't have family around here, that they don't live close to family. Because a lot of people say that, oh, well, my mom and dad or their grandparents will kick in, or my sister and my brother, they'll help out. And I'm sure they will, but not all of us have that benefit. And that definitely is a disruption in their life, right? So do you want to disrupt their life? And, you don't know how their health is going to change. Our parents, my dad has health issues. I could not count on my dad to take care of Matic, you just don't know. So it's always better to have these conversations prior to it happening. And a term policy can be inexpensive, so at least it would make sense to just have the conversation around getting some type of coverage in place, at least, you know, while the kids are young.
Sure. So while a lot of focus is on when we have these life insurance conversations are I'll say that the breadwinner of the house, it is really important that both spouses, both members of the household, we make sure that the needs match up with the risks.
Right, and the spouses, the death benefits are going to look much different.
Sure.
But there's still a need. There's definitely still a need for somebody that stays at home because that's a lot of work, and to try to figure that all out, you're really going to need some time.
Perfect. So we talked a little bit about term. What if we wanted something permanent, right? Something that's we can put in place for the rest of our lives. Where does that fit in? And who might that be for? And can you tell us a little bit about the difference between universal and whole life?
Okay. So a question we often ask is, when do you want your life insurance to pay out? So Nathan, when do you want your life insurance to pay out? Right? When I die. When you die, you want your life insurance to pay out when you die. Well, what if when you die is after your term policy is up?
Sure.
Right? So permanent policy, I can't guarantee that your term policy is going to pay out, but I can guarantee, because I can't guarantee when you're going to die, but I can guarantee that we all will die. So if you want life insurance in place for when you die, you should look at some type of permanent policy. Now, again, every situation is different. A permanent policy for one person may be to cover final expenses, burial expenses, maybe leave a little extra aside for family to grieve for one family. Somebody else might say, you know, I don't really need final expenses paid for, but I do have this money set aside, let's call it never money, that I'd like to leave to my family. If you're in good health, you can use permanent life insurance policy as a vehicle to pass on money to the next generation. Remember, life insurance is tax-free to the beneficiary. So it's a way for you to pass a sum of money on to the next generation, and they don't have to pay any taxes on it. So somebody might want to use permanent policy for that. We talked to a lot of people about permanent policies on the children. Okay, so
that was going to be my follow-up question.
Okay, so I mentioned that guaranteed insurability option earlier when I said you could add that to the permanent policies. So not every whole life policy offers this, but it's something to ask about. But with State Farm, the likelihood of your children passing before you, it's very, very small. And is it nice to have something if they would pass for grieving, for burial? Absolutely. But none of us like to go there. We don't like our minds to go there. What we focus on is that guaranteed insurability option that is included in all permanent whole life policies with State Farm from age 0 to age 18. And what that provides, it'll provide them 11 times throughout their life, starting at age 18 all the way through like 44, 45, the ability to purchase additional life insurance without any underwriting questions.
So we can get something in place for them right away, for your young children right away, at a relatively minimal cost, that then would allow them, when they reach, you know, mid-career or, you know, their 40s or whatever, say like, all right, I've got this thing in place that my parents put for me whenever I was young. You know, that was nice then, but is no longer meeting my needs. I now have an option to.
Yeah, so the permanent whole life policies have a cash value. They have you know, some are eligible for dividends. Our policy does receive dividends. We've never missed a year of dividends, although not guaranteed. But they will have options in the future. So they can buy additional insurance 11 times throughout their life if they have that guaranteed insurability option. They will, they are eligible for dividends. Those dividends sit in account and they grow. So you have the option to withdraw dividends. You can take a loan on the account. So there's a lot of options down the road. And the earlier you said it, the less expensive that policy is and the longer it has to build cash value. But like I said, insurance on kids for me more so is that guaranteed insurability option, because kids do get sick. Young kids get sick, teenagers get sick, accidents happen. I could name 10 people just in my class that have had health issues in their 20s and their 30s that would probably not be eligible for life insurance. But if they had something locked in early, they would have the option to purchase additional life insurance. So permanent, again, not every policy is the same. Not every policy performs the same way. So you really need an illustration, and you need to talk to somebody about, you know, what you're putting your money into and what you're putting in place for your family.
So can you dig a little deeper into the differences between just a straight up whole life policy and universal?
Yeah, real quick, we could probably have a whole
separate,
yeah,
just dedicated to that.
A universal life is kind of like a hybrid between a term policy and a permanent policy. And it depends on how you want that policy to perform. You could set it up so that it can perform much like a term, or you could set it up so that it performs like a permanent policy that lasts your whole life. The benefit to the universal is the flexibility. You are able to increase and decrease your death benefit, and you're able to be flexible and adjust your premiums that you put in. So universal life policies are not for everyone. They have a specific niche, and it is a policy that you need to review every few years. But I mean, there's a lot that are written. They were very popular in the 80s when the interest rates were really high. Not as popular today because we are at the, as we know, very low interest rate environment. But it really just, again, you have to have a conversation with your agent, and you have to determine what your need is and what policy best fits you and best fits your family. But you can treat a universal life like a permanent policy for sure.
Perfect. With just a little bit more flexibility on you know, payments and insurance amounts.
Yeah.
Great. Yeah. So it's a nice solution for folks. Let's switch gears a little bit. Continuing on life insurance, but talk about how many employers offer life insurance as part of their benefits package, right? And it might be some multiple of their income, you know, 1 times their income or 2 times their income. Is that enough? If I have that in place through my employer, is that enough?
Well, first off, work benefits, if you are offered work benefits, life insurance, disability, take advantage. We encourage all of our customers to take advantage of those options, because not all companies offer them, and more companies are taking them away. So it is a way for you to get benefits for a very inexpensive rate, because everyone there, you're pulling money in as a group, and we're rating you based on that group need. So take advantage. Now, is it enough? We would need to have the conversation. Maybe you do get 2 times your salary, and based on your need and based on your debts out there, that seems to be enough. However, let's say you become sick and you're unable to work, and it's 6 months, and your employer comes to you and says, you know, sorry, we have to replace you. Your family medical leave is up, or whatever. And those work benefits you're not able to take with you. You just lost your life insurance. Your family just lost what they were counting on having. So the need may be there, but you don't know if you're going to be able to take those benefits with you. And so that's why we talk to people about just putting something supplemental. When we talk to our customers, we look at we call it a life needs analysis, okay? And we talk about, if something were to happen to them tomorrow, what would their family need? Or we look at loans and debt, life, we use the acronym LIFE, so L, loans, I for income replacement. So if your family is dependent on your income, how many years of income do we want to look at? F is for final expenses or funeral expenses, so your burial costs. And then E is for education, because sometimes it is important for families to provide some type of education fund for their children to further their education after high school. So if we come up with that number, we can always subtract those work benefits from that need. And if you still have a need for additional or supplemental life insurance, then we can start there. So the work benefits are absolutely important and take advantage of them, but that doesn't mean that you don't need life insurance outside of work. Give you another quick example of why you would need it outside of work is, you might be with a company for 20 years and all of a sudden you get this incredible opportunity, your dream job, and you go and take it. But the downside is they don't provide life insurance benefits or disability benefits. You're 20 years older, you can't take your work benefits with you, and is your health the same as it was 20 years ago? So are you even eligible for insurance? So those are things that we don't think of in the moment, but we need to think in the future. So getting some type of supplemental policy makes sense for most families.
So what options would I have, or what might be a good solution for me if I am in that situation where I'm mid-career and I'm either switching jobs or I'm about to retire? What options would I have as far as life insurance goes?
Yeah, well, you always want to talk to a benefits coordinator through your current employer. I'm not saying that all group benefits aren't convertible or you can't take them with you. Most you cannot, but it's always worth the ask. So just see what your options are to take some of that work benefit with you. If you don't have that and you still have a mortgage or you still have income replacement needs, if you still have dependents in the household and you want that extra coverage, then you're going to have to go outside and talk to an agent like myself that can provide you with some options. Same thing as if you're retiring. You may still need those final expenses, or maybe you took a home equity line of credit out on the house because you were doing some remodeling, or the kids went to school and you took some extra money out, and you still have that debt that if something happened to you, your spouse may be responsible for. You need to talk to somebody, see what types of options are available for you, even if it's a 10-year term policy, 10 years to cover that gap. But it really just depends on your situation. But I think the key is to think about, you may not be at that same employer the rest of your life. And if and when you leave, are you healthy to get additional supplemental coverage? So that's usually what happens is, people leave and they want the coverage and then it's, can't, or it's so expensive because they have a health issue. So those are some things to think about. So lock it in. If you're young and healthy, lock it in now. Get something in place because that's the best time to get it.
Right. So it's always important. We always encourage everyone to try to review their life insurance needs as early as possible. But if you're later in life, your options are not gone.
Oh, no, it just might be a different path. Yeah, there's always something. And as life changes, your needs change, right? So when we put our policies in place, we were newlyweds. Then our needs changed when we bought a house together, and then our needs changed when we had our son Matic, and hopefully one day we'll pair out. So as your life changes, your needs change, and so make sure that you review your current policies.
Following up on something that you just mentioned, once we've determined the type of policy that's right for me, how do we determine the amount of coverage that I need?
Yeah. So going back to that little acronym LIFE, we sit down and we look at loans, L for loans, I for income replacement, F for funeral expenses, and E for education. And so it's different for everyone. We also have a nice little calculator at statefarm.com. If you go to statefarm.com and you search life insurance, on that main page, there's a calculator. If you scroll down to like the middle of the page, there's a little calculator, and it will just ask you the questions basically around those 4 letters, and it will come up with a need for you. But it's real easy if you think about those things, and then you can subtract work benefits if you think that, I'm gonna be here for a while and I'm gonna rely that in this 20-year time period, those work benefits are gonna be enough. You can subtract that from the total need to get that number down a little bit, but that's how we come up with it. We just have a conversation. We talk about your situation. We talk about if you have any kids in the household, if you have any loans that your spouse would be responsible for, funeral expenses, those are always in everyone's. So.
Great. Touching on something that you quizzed me on earlier, for a lot of folks, their houses are their largest asset, but there's a lot of people out there that have sizable financial assets that also need protecting. Can you explain a little bit more about how that umbrella policy can protect both?
Yeah, so if you have assets that you have worked extremely hard for, your home, your autos, those are some of the biggest assets we have, right? We work really hard to buy our houses, to buy the things that we have, and they can all be taken away like that. It takes a rainy day, driving in Oakland, and a student running out and crossing the street. I know because I did it. You're just not paying attention, and you make that right turn, and that pedestrian comes and you hit them. That's all it takes. It's seconds, and you're getting sued. In the sue happy world that we live in, there's going to be a lawsuit. And the personal liability umbrella policy gives you additional coverage above your underlying limits. Now they start at $1 million and they go in increments up in million. And a general rule of thumb is think about what you have to protect or what you have to lose if somebody were to sue you for causing injury or property damage. And we usually start with that amount.
So how much money I have saved in my retirement accounts or in my investment accounts, how much my house is worth, so all of my assets that I have, financial and otherwise. We got to look at that whole thing.
You got to look at that whole thing. And I would also encourage, talk to attorneys as well. Some attorneys will tell you that a lot of times in insurance cases that they'll look and see, well, how much liability limits do they have? And if it's a $2 million, then they'll sue for $2 million. So that's not always true. I mean, they could sue for way more than that, depending on the severity of the claim and the injuries. But there is chatter out there that happens frequently. And again, I'm not an attorney and I have no legal experience, but that often comes up in conversation. But we write a lot of $1 million, $2 million policies. It's very inexpensive for the amount of coverage, and I would highly recommend anyone listening to this call that has assets or potential of earnings too, because you can get sued for wages. They can garnish your wages, and I'd rather see you pay $15 to $20 extra a month for $1 million of coverage, just to have that peace of mind that they're not going to go after your earnings.
Yeah, we certainly do live in a litigious society.
Unfortunately, we do, and it happens all too often, and things that you wouldn't even think about. I mean, your liability, not only in the car, but if you have animals, we have dog bite, like horrible lawsuits for bites to young children's faces that have to undergo plastic surgery. We lived in the South Side and we lived in row houses. If we were negligent for leaving a candle on and that flame caused the fire to then spread to 3 others that we were attached to, we're liable for that. So that $1 million umbrella could pay for damages to the other 3 houses down the road that were affected, because we're gonna get sued.
That's why I don't allow candles.
No candles, but those are situations that you don't really think about. Another one that we had, college students. Your kids are in college, and we all have a good time in college, and often don't think before we do things. And I did have I had a claim where there was a house party, and their alcohol was given, and a girl fell off the deck and broke her leg. And it wasn't $1 million lawsuit, but it was
a lawsuit nevertheless.
It was $50,000 to $75,000, and that renter's policy liability actually extended to the damage that she was caused because the tenants got sued because they're the ones that provided the alcohol. So you have to think about these things, and every day we don't think about it. So that's why we're here. It's
an relatively inexpensive way to just, again, protect your assets. So umbrella policies are usually pretty advisable. Yep. So that ends my questions, but we did have some folks that registered to join us on the live webinar that came in with questions. So I want to try to answer some of those questions.
Okay.
One of them was, is there ever a time or age to cash out of a universal policy, if I have one?
Yeah. That's a really hard question to answer, just because I would need to see how the policy was illustrated. I would need to see what death benefit you put when you started the policy, how much premiums being put in, what those interest rates the policy was earning. Is it a fixed universal or is it a variable universal? So I'd be happy to take a look if somebody had a specific situation, but you would really want to take an illustration and sit down with somebody that has a knowledge on universal life policies to see, okay, when does it make sense for me to get out of this? And it's going to depend on how much money you put into it and the cash value when it starts to decrease. There is a point, universal life, every year money is taken out, more money is taken out because your age goes up. So mortality rates increase. So that is one thing with universal life, that, you know, as you get older, the cost of that insurance is more. So more money is being taken out of that cash account. But you would want to pull your illustration and see when that happens and see what that death benefit is that you're purchasing for the amount of money you're putting in.
So it would depend on the policy, obviously, but then more importantly, it would depend on, has your need changed, right?
Mm-hmm.
The need that you had when you had the policy written, has something changed in your life where you no longer need it? So again, it's kind of a complicated answer.
Yeah, it has to be. And yeah, I don't know if I'm answering it, but it's definitely individual basis. Again, I mean, there could be a time period where somebody didn't make premium payments. I mean, that's the nice feature of the universal life, is this flexible premium options, but that affects the cash value and affects how the policy performs.
One last question here. Everyone likes to save money. So are there any tips, hacks, life hacks that you can share with us to things that we need to be mindful of to help us save a couple bucks on our insurance rates?
Well, I think we
car, auto, home.
Yeah, yeah. Everyone wants to save, right? But you know, I think the important message here is that you don't want to cheap out when it comes to your insurance. If you have things to protect, you want to make sure that you know what your coverage is before a claim happens, right? You don't want to learn how your coverage works or doesn't work when it's claims time. So I definitely encourage you not to cheap out on insurance. Not all insurance is the same, but there are things that you can do to save on money. How we rate vehicles on, you know, the miles driven per year, you know, make sure that that's adequate or accurate. Obviously, distracted driving. There are a lot of distracted drivers out there, and they're not just teenagers. So
put your phone
down, put it on the do not disturb, you know, turn off all the sounds, because those beepers and vibrations, they definitely distract you. You know, your touch screen, that can definitely be a distraction. So that can help. Obviously, tickets, accidents help you with that overall savings. You know, just be mindful. Be mindful. You can have higher deductibles if you're willing to self-insure. That certainly can adjust the premium, but don't, just like I said, don't cheap out on insurance.
Should I shop it every 3 months?
Not if you're with me. Here's what I would say. Again, you don't want to cheap out, and not every policy is the same. And you know, you get an agent for free. Like, you don't pay me extra to look at your insurance or to advise you. But if you have things to protect, wouldn't you want to make sure that you're insured with a financially stable company, you know, somebody that you know is going to be able to pay out could you have a claim? And there's hundreds, thousands of insurance companies out there, but
check the ratings.
Check their ratings. Check, are they financially strong? Are they going to be there when you need them? If you have an accident or if you have a claim, is somebody going to be available to answer your questions? Are you going to be tossing the 100 number? If you're having an issue, do you have somebody to help guide you? You know, all those things you need to consider when you're looking at insurance.
Good stuff. All right. So take a look at your policies and make sure you know what you're paying for.
Yeah, and I would just say, since it sounds like we're wrapping up, you know, use me as a resource. My information is available. I don't charge you to call me. It's free advice, and if there's something you need me to look at, I would be happy to do it. And we all can't be experts in everything, so use your resources, and Fort Pitt Capital has been kind enough to offer me as a resource, so I'm thankful for that opportunity. So thanks for thinking of me, and please, reach out. Don't hesitate to reach out anytime.
Perfect. Well, thank you very much for joining us. I hope you found this helpful. And again, our contact information is below, and if anybody would like to talk about their situation, or if there was a question that you want answered that we didn't address, please feel free to reach out to us. So again, thanks for joining us today, and I hope everyone is staying safe and healthy out there.
Take care.